years chasing the perfect portfolio, jumping between funds, second-guessing every move, and ending up with a mess of positions they can barely explain. Because somewhere along the way, investing got complicated. More funds, more sectors, more opinions, and somehow more confusion. But what if the smartest portfolio this year isn't the most complex one? What if it's just 3 ETFs? One to anchor your money, one to grow it fast, and one to pay you while you wait. In this video, I'm going to show you exactly how to build that portfolio, even if you're starting with just $10 a day. We'll look at how each ETF performs on its own, then combine all 3 into a single portfolio. And at the end, I'll show you how that portfolio could turn $10,000 into over $500,000, and how that same portfolio could turn just $10 a day into over $1 million. But before we get into the portfolio, let's talk about where most people actually end up, because you need to see what the alternative looks like. The average American family has around $334,000 saved for retirement. That's it. And that's after decades of working, saving, and trying to do the right thing with their money. And look, $334,000 sounds good, sounds like a lot, until you actually try to live off of it. At a standard 4% withdrawal rate, that's only about $13,000 a year. That's grocery money, not retirement money. Here's the thing, if you take the 3 ETFs I'm about to show you, put in just $10 a day, reinvest dividends, and leave it alone, your portfolio could grow to over $1 million over the long term from $10 a day. That gap between where most people end up and where this strategy could take you, that's exactly what this video is about. So where does this 3 ETF portfolio idea actually come from? It's not something I made up. It's rooted in one of the most proven investing frameworks ever built, the 3-fund portfolio. This was a strategy popularized by the Bogleheads, a community of investors who follow the philosophy of Vanguard's founder, Jack Bogle. The original idea was simple. Own the entire market with just 3 funds, total US stocks, total international stocks, and bonds. Don't pick winners, don't time the market, just own everything, keep the costs low, and leave it alone. And it worked for decades. But here's the thing about this year. The world Jack Bogle was investing in looks very different from the one we're in now. International funds have spent years underperforming US markets. Bonds are paying less in real terms than they used to. The logic behind those 2 slots still makes sense. You want global growth exposure, and you want income and stability, but the original tools for those jobs just aren't the best ones anymore. So what I'm doing in this video is keeping the Bogleheads' backbone. 3 funds, 3 jobs, clean and simple, but upgrading 2 of the 3 slots for the world we actually live in today. The foundation stays. Total Market ETF handles that, and it's as close to the original Bogleheads' vision as you can get. But the international slot and the bond slot, those get a 2026 and beyond upgrade. And I'll show you exactly why when we get there. First though, before you put a single dollar anywhere, there are 3 rules you need to know. Rule 1, pick 1 ETF from each category. Not 2, not 3, just 1. Each slot in this portfolio has a job to do, and doubling up doesn't make it stronger, it just makes it messier. 1 fund per category, keep it clean. Rule 2, know your goal. This strategy works differently depending on where you are in life. If you're in your 20s or 30s, you've got time on your side and you might want to lean heavier into growth. If you're closer to retirement, income and stability matter more. There's no wrong answer here, but you need to know which one you're building toward before you start. And we'll come back to this at the end. Rule 3, stay consistent. Good fund picks mean nothing if you bail at the first sign of trouble. Reinvest, don't panic, and let time do the heavy lifting. Those are the 3 rules. Simple, but they matter. Now let's get into the portfolio, starting with the fund that anchors the whole thing. Every portfolio needs something at its core that you can trust no matter what the market's doing. Not the flashiest fund, not the fastest grower, just something solid, broad, and built to last. That's what this first ETF is. It's called VTI, the Vanguard Total Stock Market Index Fund ETF. And the name tells you exactly what it does. It owns the total U.S. stock market. Every publicly traded company in America, over 3,500 of them in a single fund. So when you buy VTI, you're not making a bet on any one company or any one industry. You're making a bet on the entire
And historically, that's been one of the safest long-term bets you can make. Think about what that actually means in practice. When tech pulls back, healthcare might be carrying the weight. When consumer stocks struggle, industrials could be picking up the slack. The whole market balances itself out over time, and you're along for the entire ride without having to pick winners. This is also the ETF that stays most true to what the Bogleheads originally built. Jack Bogle's whole argument was that you can't consistently beat the market, so you're better off just owning it. VTI is exactly that, the whole market at one of the lowest costs you'll find anywhere. It's not going to be your fastest grower. We've got another ETF for that, but it gives your portfolio a foundation that can weather recessions, crashes, and whatever the news cycle throws at it next. You need that anchor before anything else. Now let's talk numbers. VTI currently pays a dividend yield of 1.13%, and those dividends have grown at an average of 6.16% per year over the last 10 years. On top of that, the fund has averaged 12.45% in annual share price growth over the same period. So what does that actually look like in your pocket? If you put $10,000 into VTI today and reinvest every dividend you receive, after just 1 year, your portfolio is projected to grow to $11,358. Give it 10 years, and that same $10,000 could be valued at $34,883. By year 20, you're looking at $117,350, and by the time you hit year 30, the projections show that initial $10,000 growing to $387,355. Out of that total growth, $368,471 would come from capital appreciation and $8,884 from reinvested dividends. So the total value added to your original investment could be $377,355. That's what a reliable anchor looks like over the long term, building wealth in the background while you get on with your life. And honestly, VTI alone could already get you past that $334,000 average retirement savings figure we talked about earlier. But matching the average was never the point. The next ETF is what starts pulling you well beyond it. Next, I'll show you the remaining 2 ETFs, and at the end, I'll combine all 3 into a single portfolio that could turn $10,000 into over $500,000. And just $10 a day into over $1 million. But first, let's talk about the growth slot in this portfolio. In the original Bogleheads model, this slot was for international stocks, the idea being that different countries perform differently at different times, so spreading across borders smooths out your risk. And that made a lot of sense 20 years ago. But the world looks differently now. The biggest American companies aren't really American anymore. Apple sells more iPhones in Asia than in the US. Microsoft runs cloud infrastructure across Europe. NVIDIA's chips are powering AI data centers on every continent. If you already own the top US companies, you're getting global exposure through the companies actually winning the global race. So instead of parking money in a generic international fund that's spent years underperforming, this slot gets an upgrade. And that upgrade is QQQ, the Invesco QQQ Trust. QQQ tracks the NASDAQ 100. That's the 100 largest non-financial companies listed on the NASDAQ exchange. And what you get inside is a concentrated bet on the companies shaping how the world works right now. We're talking semiconductors, artificial intelligence, cloud computing, digital advertising, biotech, e-commerce. These aren't speculative startups hoping to figure it out. These are profitable, cash-rich businesses that dominate their industries globally. Now, QQQ isn't for the faint-hearted. It moves faster than VTI. And when the market dips, QQQ can dip harder. But when it recovers, and historically